Welcome back to Abhik Parth. In Chapter 7 of the Little Book of Common Sense Investing by John C. Bogle, we discuss the dangers of chasing market expectations and how speculation can derail your investment journey. Instead of trying to predict the unpredictable, this chapter teaches us to focus on the realities of investing and the power of patience. Let's explore with practical examples. Key Lesson 1: The Folly of Forecasting. Many investors get caught up in the hype of market forecasts, but the reality is that no one can predict the market with consistency. Stock prices are influenced by emotions, speculation, and short-term trends. Over time, market returns are driven by business fundamentals, not predictions. Example 1: The prediction trap. In 2020, many analysts predicted that the stock market would crash due to the pandemic. But by the end of the year, the market recovered and hit record highs. Investors who sold their stocks based on these forecasts missed out on the recovery, proving that speculation is a losing game. Key Lesson 2: The Reality of Returns. Bogle introduces two key components of investment returns. Investment returns, dividends and earnings growth. Speculative returns, changes in the price to earnings, PE, ratio driven by market sentiment. Example 2: Long-term focus versus speculation. Consider two investors. Investor A, speculator, buys a stock because he believes its price will double in a year. Investor B, long-term focused, buys the same stock because it offers a steady 5% dividend and has strong earnings growth. A year later, the market sentiment shifts, and the stock's price drops. Investor A loses money, while Investor B continues to earn dividends and benefits from the company's long-term growth. Key Lesson 3: The Importance of Staying the Course. The chapter emphasizes that true investors stick to a long-term strategy instead of trying to time the market. By focusing on low-cost index funds, you can capture the market's true returns over time. Example 3: Ramesh versus Suresh, timing versus patience. Ramesh invests 1 lakh rupees in a high-growth tech stock, hoping to sell it for a quick profit. However, the stock crashes, and he loses 30,000 rupees. Suresh invests the same amount in a diversified index fund and leaves it untouched for 20 years. Despite market fluctuations, his investment grows to 6,72,000 rupees, thanks to compounding. Suresh's disciplined approach highlights the importance of patience over speculation. Key Lesson 4: Recognizing Speculative Bubbles. Speculative bubbles occur when stock prices rise far beyond their intrinsic value due to hype and herd behavior. Bogle warns investors to be cautious during market euphoria, as bubbles eventually burst. Example 4: The dot-com bubble, 2000. During the dot-com boom, tech stocks skyrocketed as investors speculated about the future of the internet. Companies with little to no earnings were valued at billions. When the bubble burst, the Nasdaq index fell by 78%, wiping out trillions of dollars in wealth. Investors who avoided the hype and stuck to fundamentals protected their portfolios. Focus on fundamentals. Invest in companies with strong earnings, dividends, and a history of growth. Stick to index funds. Avoid the temptation to pick individual stocks or time the market. Be wary of predictions, ignore market forecasts, and focus on your long-term financial goals. Avoid herd mentality. Just because everyone is buying doesn't mean it's the right time to invest. Chapter 7 reminds us that the stock market is a weighing machine in the long term, driven by real business performance, not short-term predictions. By staying disciplined and avoiding speculation, you can achieve the steady growth that builds wealth over time. Movie camera: want to master the art of long-term investing? Check out the full playlist for the Little Book of Common Sense Investing playlist link. Speech balloon: tell us in the comments, how do you stay disciplined during market hype? Bell like, share, and subscribe to Abhik Parth for the next chapter. Welcome back to Abhik Parth. Today, we explore Chapter 8 of the Little Book of Common Sense Investing by John C. Bogle. This chapter takes a hard look at the common mistakes investors make, turning what could be a winning strategy into a losing game. Let's uncover the lessons and learn how to avoid these costly pitfalls, complete with practical examples. Key Lesson 1: Overconfidence leads to poor decisions. Bogle highlights that many investors believe they can consistently beat the market, but studies show otherwise. The average investor underperforms the market due to overconfidence, impulsive decisions, and high costs. Example 1: The mutual fund dilemma. Rahul decides to invest in actively managed mutual funds because he believes fund managers will deliver better returns. However, over 85% of actively managed funds underperform index funds in the long run. Rahul not only loses potential returns but also pays higher fees, eroding his wealth. Key Lesson 2: Chasing past performance. Investors often pick funds or stocks based on their past performance, assuming they'll continue to deliver high returns. But Bogle warns that past performance is not an indicator of future results. Example 2: The Star Fund Trap. In 2018, a star fund gained 30% returns, attracting thousands of new investors. By 2019, the fund lost 15% as market conditions changed. Those who jumped in based on past performance were left disappointed. Key Lesson 3: The cost of frequent trading. Frequent trading not only increases transaction costs but also exposes investors to emotional decisions like panic selling or greed-driven buying. Index funds eliminate this risk by promoting a buy-and-hold strategy. Example 3: Raj's trading habit. Raj starts with 1 lakh rupees in the stock market. He trades frequently, hoping to profit from daily price movements. Over time, he incurs 15,000 rupees in brokerage fees and taxes, reducing his returns significantly. In contrast, Priya invests 1 lakh rupees in a low-cost index fund, leaves it untouched, and sees her investment grow steadily. Key Lesson 4: Ignoring costs eats your returns. Bogle emphasizes that high fees, commissions, and taxes can drastically reduce your returns over time. Index funds, with their low costs, help you keep more of your hard-earned money. Example 4: High-fee fund versus index fund. High-fee fund charges a 2% annual fee. If you invest 10 lakhs rupees, you lose 2 lakhs rupees in fees over 10 years. Index fund charges a 0.2% fee, costing only 20,000 rupees in the same period. By choosing low-cost funds, you retain more of your investment gains. Key Lesson 5: Emotional investing is a recipe for failure. When the market rises, greed makes investors buy at high prices. When the market falls, fear leads them to sell at a loss. Successful investing requires emotional discipline and a focus on the long term. Example 5: Market panic. During the 2008 financial crisis, many investors sold their stocks in panic, locking in their losses. Those who stayed invested saw the market recover and even thrive in the years that followed. Stick to your plan, avoid reacting to market noise, and stay committed to your long-term goals. Invest in index funds, reduce costs and avoid the temptation to chase past performance. Limit trading. Frequent trading increases costs and risks. Stick to a buy and hold strategy. Control your emotions. Don't let fear or greed dictate your decisions. Avoid high fees. Choose low-cost funds to maximize your returns over time. Chapter 8 reminds us that investing is a winner's game if we follow simple, disciplined strategies. Avoid the common pitfalls of overconfidence, high costs, and emotional decisions, and you'll set yourself up for long-term success. Movie camera, don't miss the next chapter, where we discuss how to maximize your returns with simplicity. Subscribe to Abhik Parth and hit the bell icon. Speech balloon, what's the biggest mistake you've learned from in your investment journey? Share in the comments below.